We are getting Craig online here. Looks like he's joining us. Hello, Craig.
Hey, good afternoon, everybody.
You got
Appreciate everybody joining us and Whaley. Uh,
absolutely.
and to our clients across the country and prospective clients, welcome to our webinar on employee benefit accounts and charitable donation accounts. It's now the new and exciting 201. So we're going to cover just a few concepts from our first 101, but we're
That's
going to
right.
take it, just a step level going forward.
Going a little deeper on this one.
All right. So I'm Craig. I think most of you know me, so Chief Investment Officer here at McQueen Financial Advisors. I'll talk a little bit about McQueen before giving a little bit of bio on Zach. McQueen Financial Advisors is a SEC registered investment advisory firm providing investment management to banks, credit unions, trusts, foundations, non-profits and endowments across the country now. And we also have our asset liability management team where we run analytics for ALM, CECL, liquidity, concentration risk, just to name a few. And then we also have our M&A division as well, doing mergers, acquisitions, transaction advisory, merger searches for the
Hmm.
industry as well. And then I'd like to introduce Zach Whaley, one of our senior investment advisor. He is our team lead for all of our charitable donation accounts and employee benefit accounts. He's been and works with clients across the country, not only on asset management, but also interest rate risk management, meets with boards and management and consulting and advising for best strategies for their balance sheet and for the membership and owners of institutions. So, Zach, welcome and appreciate you joining us today.
What a great intro, Craig. I appreciate that.
Yeah, you're very welcome. A few administrative things we'll cover is at any point in time at the bottom of your screen, there's a chat or a Q&A. I think both work. So if you'd like to present a question throughout at any point in time, please do that. We'll be monitoring that throughout and answer them when appropriate during the presentation, and some that might be at the end as well. And also, we will, with most, actually not with most, with all of our webinars at our website. Today's presentation, along with all of our historical ones, will be on our website. And if you go to our homepage at the top ribbon, you can click on webinars. It'll have all of our historical ones there for you too, as well as listing of future ones that we have that are upcoming. So we got several of them between now and year end.
All right. Well, that brings us to our topic at hand, Craig. So good to be with you again on one of these. I love this.
Yeah, we ride again.
We ride again. And we're riding with my favorite topic. So we're going to talk about, as Craig mentioned, EBPA. That stands for Employee Benefit Pre-Funding Account, and CDA, that stands for Charitable Donation Account. We're going to talk about one of my favorite topics, which are both of those accounts. So, a quick overview. We're going to do a recap for 101. If you happen to miss our 101 webinar, you can see that on our website as well or YouTube. We're going to bring you up to speed though. So, if you saw 201 and you said, I don't know anything about this topic, I'm going to jump right in. Welcome. We'll bring you up to speed. We're going to talk a little bit about standard portfolios that you're probably used to, compare and contrast that with the EBPA and the CDA. My favorite topic on today's webinar will be the goal setting. We're going to spend a little extra time there. It's going to be great. Talk about strategy, go quickly over accounting and other considerations because we've really gone into that in a lot of depth before. Don't want to belabor that in 201. And then wrap up with some perceived obstacles that you may have thinking about, I really want to do this, but I have these things standing in my way. We're going to cover that as well. And then end with next steps and questions. How's that sound, Craig? All right. So
Yeah, it's
first of all, before we look at the recap, I want to talk about why now is such a good time to be on this call or watching this in the near future. So we are at a time right now where interest rates are still near their historical highs. As crazy as that might sound, with them coming down recently, they actually are still very high, especially on the long end of the yield curve. The Fed came out last week and they surprised some and they gave others exactly what they wanted and a 50 basis point rate cut, which is probably beginning the cycle. Craig, are we at the beginning of the cycle?
Yep. The trend, as we know, is your friend. And
Hmm.
we have had a major pivot point on the Fed policy, and we're seeing a little bit of a change. And I know you've mentioned it on the fixed income side, but also I want to make sure talking about timing is the equity markets as we flirt with those all-time highs there as well. So it's just interesting what's happening on our economic cycle, and it's going to be, a little bit different over the next couple of years of what we're going to be seeing, both in this business cycle.
Absolutely. A great time to think about strategy, how to navigate it. The environment, if it does turn out the way that we're predicting and the Fed continues that cutting cycle, at least over the short term, one of the things that is paramount to talk about is how do we protect against those falling rates? And one of the ways to do that is to limit your optionality in your portfolio. We don't want to buy callable bonds right now. We want to avoid those types of things. And the EBPA and the CDA can really help towards that end. Also, what I really like is that they create a non-correlated asset. These investments are going to act a little bit differently or a lot differently than the other assets on your portfolio. The prime example are your loans. If interest rates go down, they are going to refi, especially the ones that were done over the last couple of years. At least a lot of them will. And we want to protect against that. We know that inflation has been a huge topic of conversation. And it's funny because inflation is coming down, but that doesn't mean things are getting cheaper. It means that things are getting more expensive at a slower pace.
Well said. Yes. So we still have inflation.
Yes. Yes, and if we have inflation somewhere, we have it everywhere, and that's exactly what we're seeing with employee benefit costs. Typical inflation right now, call it around 3% or so. Medical expenses are about twice that, so we really want to learn how to offset that. Non-interest income is disappearing. Had a conversation literally about that today. How can we compensate for some of those expenses going away, some of those fees, spread compression, and also budget seasons right around the corner, Craig?
Right. And I like how you mentioned the inflation on running our organizations, right? And as we talk about the spirit of today in the charitable donation world, as we give to entities and try to support our communities and become that steward of the society, is the recipients are having that same experience on their budgets, right? So it's costing more to run and help and support. And so any kind of incremental increase that we could do to help support them would be great. And we're going to talk a lot about that today of how to increase some of our giving to the communities.
I love that point. A $5 donation of yesterday might be a $4 donation of tomorrow as far as how they can put it to work.
Well
It's a
said.
really good, I love that. Yeah. So in the last bullet point, budget season, I just want to pause on this really quick. It's right around the corner, right? We hear about October a lot. It's a great time to put this on your agenda if you haven't talked about it already. We'll give you plenty of talking points for that. Okay, so now is time for a quick 101 recap. The EBPA stands for Employee Benefit Prefunding Account. And what this is, the NCUA, or governing body of credit unions, they saw how expensive it was to pay for employee benefits, and they wanted to help credit unions offset that. So they created regulation that allows you to take a portion of your excess liquidity to cover benefit expenses. How this works, you are allowed to invest up to 25% of your net worth. That is regulatory guidance. It's not a hard, fast rule, but we like that guidance as a starting point or something to work towards. You are allowed to invest in newly permissible investments that you might not have in your standard portfolio, that you shouldn't have in your standard portfolio. Greater yields, and the goal really is to offset your benefit expenses. Now, this page I want to spend a little bit more time on because the really the 101 is what is an EBPA, and really the 201 is why do I want it and how do I best execute on it. So here are some whys. First of all, I love the bullet point of attracting and retaining key talent, right? If you can offer better benefits right now, you are going to be able to have better interviews. You're going to be able to say, hey, we want you to come join our team. Take a look at how lucrative our benefit package is. It's a very important thing. Also, the job market ebbs and flows with how competitive it is. If you want to be able to retain your key personnel, having those employee benefits in place are very crucial so they're not lured away by a better benefit package. Um, when we think about these investments, we are looking at higher spreads. That's the whole reason why we do them, right? Bottom line is, what can this do for me from a dollars and cents perspective? It can earn higher spread than other investments. Standard portfolios right now, depending on the type of asset that you're getting into, can yield anywhere from zero spread, treasury, right?
Hmm.
Up to 50 basis points thereabout. That's really if you're looking at getting into maybe taxable munis and corporate bonds, maybe some bank notes, where the EBPA is really giving us much more spread, 170 to 200 basis points more, or total spread, I should say, is about 3 to 4 times of an increase from your standard portfolio.
Significant increase when you think about, the earning capacity and how what it really may translate into dollars and cents.
Absolutely. When people do have liquidity, where should we put it? Let's have a conversation, right? Because both are important. The standard portfolio in these accounts. Craig.
All right, so this next bullet point, I I,
Yes.
I think I'm going to need a little bit of clarity because you
Okay.
got, both offense and defense. Is this like I intercept and I'm defense from trying to score a touchdown, turning into offense?
Yeah, this is a obscure Detroit Lions reference, is what it is, right?
Because
So
they throw interceptions, is what you're saying.
they did 2 weeks ago. But so this is a great, I had actually a good conversation with our lead in the mergers and valuation team that we have, Dan Martin. And we had a conversation about just how powerful these tools are for offense and defense when it comes to M&A. So to explain that a little bit, if you're playing offense, right, you are looking for somebody to merge into your institution, right? How can I find a credit union and attract not only the credit union itself, but the individual people that are there? Well, what you can do is you can open up an EBPA, accumulate a benefit that will actually go towards the executives in that new institution that you're bringing in. So now you're not only attracting them to do the initial transaction, you're encouraging them to stick around for the long term. Does that
Yeah.
make sense?
It does. It makes a lot of sense because we know when looking at the combined synergies of institutions, for whatever reasons they may be, there's always key people that you want to keep, and you really want to keep everybody if at all possible. But some of the people that you may want to attract might not want to be wanting that same opportunity, and they might move on. So this is really a great key tool to utilize to retain them. You said open up one to
Hmm.
do this. Is that, really the best way to do it, or is it more like have something, a program going that you can say, we have a program to retain executives, so here's what it is for you.
Great question. So we'll actually go into example a little bit later where if you have
Okay.
one, you can move someone into it. But I'm glad you asked that question because down here, and I'll get back to defense in a second, but we advocate if you do not have an EBPA and you are looking at potential merger potentials, start this in advance. Right. We want to get this going. That way we can accumulate the benefit. It can already be there and then we can simply add those other executives into the program once the merger takes place or
Makes
the
sense.
acquisition. Yeah.
Makes sense. Yeah.
And then quickly on the defense, it's just the inverse of the offense, right? If you are maybe a smaller credit union and you're looking to stay independent and you want to avoid being looked at by another credit union that might want to absorb you into their mission, you want to keep yours independent, start these in advance and have your executives incentivized to stay independent with you rather than looking at that offensive, attraction from another credit union that might offer them something. So you can use it both ways, and both of them are completely valid. We already mentioned protecting falling interest rates, and of course, these programs are 100% customizable for you and your goals. All right, so a quick recap on CDA. We'll get into the fun stuff. The NCUA also allows you to take a portion of your assets and put it towards normally impermissible investments to cover charitable donation expenses or to increase your giving. They understand this is your main mission is to give back to your community. This allows you to do a focus on that and do it better. How a CDA works, very similar to a EBPA, but the limits are different. There's a few other caveats. The first difference is you can invest up to 5% of your net worth instead of 25. These are smaller accounts. You can invest in the same type of investments as the EBPA in order to get greater yield. But the biggest difference is the purpose. The goal is to have those earnings greater than your normal investments or traditional investments to offset your giving. All right, so now the fun page, Craig. Why start a CDA?
That's a really good question. I think there's a lot of multitude of benefits for a charitable donation account for all of our clients, to be honest with you, because they're all kind of supporting, their missions, right?
Absolutely. When I go to credit union conferences or I'm in a board meeting, I always hear about the social mission, right? Credit unions were originally designed to serve the underserved, to be there for their community. So this allows you to focus on that, protect that mission with a particular account with sole purpose is to continue that social mission. And I really like too how it allows you to interact more with your community. And think about this. You want to be involved, right? Not just with your money, but potentially with your time, volunteering out there in the community. Well, sometimes it takes you money to spend time, right? You have to have resources. You're going to have to take people who are taking time off of work. You want to accumulate the ability to interact with your community more. And when you do that, you're out there and you're helping people out, you will attract the cameras, as I heard one of our friends say once, right? He said, you do not have to call the cameras will come to you when you do something good. So people will see you acting in the community, giving to the community, and they will be attracted to your institution. Ultimately, maybe decide to open up a checking account, savings account, or something else.
Yeah,
Definitely
it's
love
like
that interaction.
yeah, it's like a win-win, right? You're helping the community, and it could translate into more membership. I do like that.
Absolutely. Absolutely. Do good and you get good. So we also like to incorporate the idea of starting a foundation. Now, you definitely don't need this, but we'll talk a little bit more about this in future slides. But I love that connection. We'll get into it. We've already talked about spreads. Now the concept of the offense and the defense. And this one is a little bit more interesting to me because when I first heard this, I was like, wow, that's really cool way to think about it. From an offensive standpoint, if you are doing good in the community and you have a great presence, now let's think about you want to bring another credit union into that or have an acquisition that's brought into that. And maybe they have limited resources. They have all these big ambitions and goals. They've lacked the resources. Now they see that a partner is coming along that can help them. They're like, wow, you guys are doing this. And what do you do with your CDA? And how are you giving? We want to be a part of that. You can attract people.
Yeah, but join something that has a great reputation of doing good.
Yeah, absolutely. And then on a defensive side, well, if you want to do that yourself and not need another partner to bring you into their vision, you want to really have that own vision, well, then set this in place so that you don't have to look outside your own four walls and you can do it yourself, which is just another way to think about it. And of course, we talked about these bottom bullet points, so we'll move on. Um, we'll do this section quickly as well. The difference between the standard portfolio and the EBPI. So these are some investments that we're all familiar with, right? Most credit unions are buying CDs. Often we have government agencies, maybe some mortgage backs, and then many have munis and corporate bonds. Not all, but these are assets that we're familiar with. Now, standard investment portfolio is designed with a different purpose in mind than what we're talking about today. Increase in yield, supporting loan demand, having liquidity for you. And in order to do that, we really need to have a short-term ladder so we constantly have investments coming off, or maybe a barbell strategy, short-term investments, long-term investments, a little bit of a gap in the middle. But when we think about an EBPA, we can or CDA, we can introduce corporate bonds that maybe have a lower credit rating, a higher yield within reason, of course. Preferred stocks, which is kind of a hybrid in between a stock that most people are familiar with and a corporate bond. You can also have ETFs, mutual funds, individual common stock. It can be built in many different ways depending on what your needs are. And then Craig, I'll leave this last one for you. What's an alternative in an alternative portfolio? What's an alternative inception
No,
here?
I really like that. Thank you for asking. It does sound a little bit different, but
Yeah,
we're looking at liquid alternatives, meaning if someone wants to have a really diverse portfolio with combination of equities, fixed income, but alternatives would go towards maybe the precious metals or energy sector or something of that nature, where there's liquid ETFs or that could trade on that. So some kind of dabbling in that, that's liquid that you can trade and earn a decent return.
absolutely. Have you seen a gold chart lately?
It's
It's doing
going up.
doing quite well. Doing quite
Yeah.
well. So a lot of different ways to take a look at this. All right, so in summary, we're looking at this section, not the whole webinar. Don't get excited. We're increasing yield over standard investments, offering better benefits, giving more to the community. But really, what I wanted to highlight here is because we're not focused on that short-term liquidity aspect of the standard portfolio, we typically have a longer duration, 5, 15 years, can be longer or shorter if we need it to be. And we can now invest in things without maturities at all. We can have stocks and ETFs. Okay. Craig, we talked about this as being our favorite section of the webinar. Let's
It
get
is.
Yeah, let's get into some goals and we have two here that we want to review. So EBPA goal setting is what we're going to talk about and defining our objectives and looking at the timelines of those objectives. And are there only two ways to do this, Craig? How many ways are there?
There's unlimited, really. The creativity you can with an employee benefit account, it's unlimited. And we wanted to introduce today, which we're going to cover is one very common one and then one unique one that people are thinking about. But ultimately, the goal of the account should be pretty similar across everybody's organization, right? It's getting expensive to run there. And
Hmm.
we have a industry. It's no hidden secret. We're in an industry of consolidation taking place. So what can we do to have the edge to thrive and also survive in this environment? And these are some strategies here to help us out on a go forward basis.
Yeah, absolutely. Neither one of these is better than the other, as you mentioned, Craig. They're just different strategies amongst many that you can do. But let's look at these. So the first one here is what if you just wanted to increase income indefinitely in order to specifically offset your employee expenses, right? We could consider this a 101 type goal. Not that 101 is worse than 201, but it's like a kind of like a simpler goal that we can achieve. Um, Number two would be more of a 201 goal, which is like a more of a highly specialized goal. And that's what if we had executive payouts that we wanted to do at specific dates, retirement for your CEO, CFO, other C-suite positions. And what I've been having a lot of these conversations over the last couple of weeks, and what I'm hearing is that there's an increased regulatory focus on succession planning, which I think is incredibly important. If you think about, as you mentioned earlier, Craig, the key people of your organization, they're the lifeblood. You've got to retain them, and they must be retained for long enough for them to train the next generation of leaders. And then the leaders have to be incentivized to stick around to start the cycle over again, right?
Yeah. Yeah. And then depending on certain organizations, we have seen where there isn't enough succession planning, right? Especially in there does this come to a point, as terrible as it sounds, smaller organizations sometimes don't have the resources to retain somebody, that bright, young, upcoming person to help train and retain. And this is one of the ways that we can help them really accomplish that.
And remain independent if
Yeah,
that's their goal, right?
right on.
So let's go over the first one here. Let's say we want to increase our income indefinitely to offset employee expenses. So first of all, we want to determine the size of the portfolio. We want to see where the boundaries are on the playing field, right? Where are the sidelines that we can play in? And so one of the ways to accomplish that is to run a funding analysis. It's really simple. We'll get into it on the next slide. But it's essentially this. You want to look at your last year's costs. How much have you paid on all these different items that can be classified, right, as benefit expenses? And what do you expect the increase of that to be in the future? Then we can say, okay, what portfolio size would we need in order to offset 100% of those expenses? And I'll give you a spoiler, it's going to be bigger than what you can do from a regulatory standpoint. And it's not because the EBPA isn't great, it's because your expenses are very large typically, especially the bigger institution that you have. So often 25% will be your limit. That'll be your limiting factor. But now, because we did the analysis, we have the documentation. We know we talked about it. Makes for a way better first exam once you have one of these in place, right? Hey, I did my due diligence, and we can confidently fund up to that limit. Of course, keeping your liquidity in mind. Might not do that right away. And then on a go forward basis, we want to continue to run this funding analysis to make sure that we're keeping an eye on how our expenses are most likely increasing.
Right. It's interesting you mentioned the word not fund it right away.
Hmm.
So someone that's maybe interested in doing something like this can slowly, open an account, get it ready, and just dip the toes into the water of starting to fund it with a small amount. They don't have to just immediately put in 25% of their net worth.
Not at all. We do it all the time. It's really wrapping your head around how this program works, maybe a goal of where you want it to be fully funded. But we understand the liquidity is just not there for everybody. It's coming back, but if you can just get something started, the way I always think about this is it is so much easier to add to it than to start it to right at the beginning. It's not hard to start it, but it takes a little bit of time. So have it in place and we can just add money as liquidity comes in. All right. So this is what the funding analysis looks like basically, and we can provide this for you if we're partnering on this program, right? So you're going to record your different employee benefit expenses. That feeds into an analysis. These are just snippets of bigger documents, by the way. They're not this simple. They're a little bit more to it. But what it shows is what your current cost of benefits are and what it would take to fund that. And then it looks at your regulatory guidance, as we just mentioned. And then we can make a decision on what size portfolio would make sense for you keeping within that regulation.
Yeah. So in this example, what I'm seeing is in order to cover 100% of those expenses, it
Yep.
would take about $4 million in this investment, whereas the regulatory guidance would be, well, you only can put 2 million in there. So that's what kind of you were saying earlier, you wish you could put in more, but
Right.
there is risk reward and there's limitations there. Okay,
Yep.
thank you.
Yeah, you bet. Exactly. All right. So now we'll get into the 201 strategy. What does that look like if we think outside of the box of just general, offsetting expenses? And really, this is a bonus round, 2 for 1, Craig.
This is the fun round, if you ask me. This is like playing Jeopardy and going all the way down to that 500 line. I'll take 201 for 500, please.
Here you go. We'll do it. Grab the 500 and we've got executive payouts and we've got M&A. So we're going to wrap in two things in one here and let's look at this. So let's say you wanted to plan for specific executives, whether they're on your team now or you plan on bringing them in with a merger. Well, what we want to do is determine the size of the portfolio. We can either start with the amount of money that you're thinking to put to work, or we can work backwards to decide how much we need in order to fund your goal. Both are completely fine. And some of the questions you're going to want to ask yourselves, how many executives are going to be in this plan? When are they going to retire or look at a bonus payout? And what is the payout amount? Another consideration that may not be immediately apparent is, are the payouts going to be salary based? Makes a lot of sense. It's kind of a way to make things fair and relative, right? Well, then you want to be able to model what the salary increases are going to be over time. That's an important metric as well. Okay. So now before anybody clicks away, because there's a lot of information on this page, it's not too bad. Actually, you guys are used to cash flows statements. You understand what we're looking at here, but I'll walk us through it. And Craig, I'd love to hear your thoughts on this. This particular plan is saying, what if we invested $10 million and we had a goal of paying out our executives a percentage of their salary, and this particular example, 300%, and we're going to assume salary increases of 5% every year. What we then look at is we walk forward in time. We look, this example has many employees. Your plan may only have one or a couple. We have many employees that are retiring in different years. And that initial investment is going to generate income. There will be reinvestment income. I won't really go into that. It's a bigger part of the model. But then at the end of that time frame, the account is getting bigger. And then through the magic of compound interest, you're growing the account and you're making interest on interest. And that goes forward in time. And we can see as these employees retire, they are getting paid out. But you'll notice the account value continues to rise because we're making more income than our expenses are, which is awesome.
So as I look at this, Zach, we're starting out with an initial investment, and with this illustration, this hypothetical illustration, even though that payout column, we're having executives retire and we're paying them a quarter million, a third of a million, 40% of a million. Those are our ending value just continues to rise. That's
Abs
hmm,
Absolutely, just because of the size of the account and the return. Now, to be really clear, depending on the amount of money, maybe you don't have 10 million lying around and you want to pay your executives 10 times their salary, right? The math might be a little bit different.
understood. So you're kind of
Right.
making something based on your executives, who's retiring and when, and what's fair and what makes sense, prudent for the institution as well. Okay.
Yes, and speaking of the prudence of that, at the end of this time frame, you can see we end up with a very large account value, which is in excess of that initial investment, which is a 37% increase or annualized that represents 2.3%. Now, we still want this excess earnings to be attributed to the other benefit expenses that exist outside of these payouts. That's part of the analysis that we want to consider. But you can see this is very lucrative for the credit union as a whole in order to offset even more expenses than what we're showing here with these executives.
So I have a question that could come in, and I
Hmm.
do think it's best to answer this question now than later on. And it said, in this illustration, could one of these employees listed on this example be somebody that we're merging in from another institution?
Yes, exactly. That's awesome because if you look at this, maybe you have two different examples of that. Maybe you're merging in an institution with a CEO that they're looking to retire really soon,
A
right?
year, two, three. Okay.
Exactly. So maybe that's your employee number one here. Maybe you have some younger people with a different goal of sticking around for a long time. Maybe those are employees seven, eight, and nine, right? And because this particular program, and again, it models based on how our numbers are for you, but this particular program could bring in even more executives into this plan. So you can absolutely use this for a merger tool, have it in place for your current, maybe you don't even want to do any merger work at all right now, but you have this in place for your current executives. It will be a tool that you will be glad that you have for those potential opportunities in the future.
Yeah, to attract them and to retain them and have a benefit package that is, compatible to the industry, if not better.
Absolutely. If this package is better than what they had before, they're going to be rooting on that merger all the way. Bring me in. So I love this. I think it's very flexible and this can be done in a lot of different ways. So let's keep it moving here. Um, CDA goal setting, right? Well, the high level one is we can increase our income indefinitely. We want to just offset charitable giving, but maybe we want to have more of a targeted goal of funding a foundation in a certain amount of years. So let's talk about that. First, we'll touch on what if we want to just increase our income indefinitely to offset our charitable giving. So some initial considerations. What is your current giving? What are you giving right now? Let's think about that. Most people can have that at their fingertips. And then what is a future giving goal? How much more do you want to give in the future? The thing to consider is the max size of a portfolio is 5% of your net worth. And depending on whether you're state regulated or federally regulated and what state you're in, um, 51% or 100% of the earnings will be given to a not-for-profit, a 501(c)(3) or 501(c)(19). So it really depends on what your giving goals are to what you need to be thinking about before you launch this program. And one of my favorite things is what new causes would you support if you could? I love that idea.
Sure. Yeah, because everybody has existing causes. Everybody is contributing, and it's just a function of we have members that are coming in, especially if we're community based, that are coming
Mm.
in from different areas, and there's always another avenue that we could support and help our membership and what's important to them as well.
On that note, Craig, I've heard of credit unions advertising and opening this up to their membership saying, hey, such and such credit union gives back. Tell us about your favorite charity so that we can become more involved. I think that's such a cool idea.
Oh, that is really neat. Getting the
Yeah.
membership involved.
Yep.
That's what PR that is, just creating that.
Yeah, absolutely. And then also, what are current causes that you want to give more to, right? So here's a very simple example, very simple example. But what if you wanted to donate $100,000? Well, if you had $2.5 million earning 4%, that's what it would take to fund 100,000. Where are we getting 4% from? Well, treasuries, depending on the part of the curve, call it around 3.5%, depending on the day. But if you get a little bit of spread, maybe you're getting 4%. So you could move 2.5 million and make $100,000 at that return. With a CDA, depending on the structure of the portfolio, we can target different returns. We're targeting 6% here. We can do higher, depending on the structure, of course. But 1.6 million earning 6%, same amount of giving, and you've almost removed, you found $1 million basically.
That you don't have to really invest to achieve what you're looking to donate.
Exactly. And maybe, I hear liquidity, liquidity, liquidity all the time. It's one of the most important things. Well, hey, we found another $1 million you could use for something else. So, what if you want to increase your earnings or give more? So, let's look at this. What if we had a hypothetical credit union with a $40 million net worth? These numbers we use to just show simple math, and they're currently giving, over 50 grand. It's called $60,000 for illustration purposes. Well, that credit union, 40 million times 5%, they could fund a $2 million CDA. And if that $2 million CDA earned 6%, they'd be making 120,000. So, and they're used to giving, let's say 50 or 60. So in this example, they could use $60,000 of the 120 in order to offset their current giving and then increase the bottom line by the other. Now, this is using the federal regulation where you're only required to give away 51%. Again, if you're a state chartered credit union, let's have a conversation about if that applies to you or if state regulation would be different than that. Or the more fun thing to do, well, depends on, I guess, how you want to look at it, just give more. You're used to giving 50 to 60,000. What if we double that to 100 or 120,000?
Yeah, it's interesting. So in this whole process, how does one find out what their state requires on these type of accounts with respect to giving away earnings?
Well, you can do it the hard way or the easy way. If you want to do it the hard way, good luck on Google. Look
Yeah.
up your regulation,
Or
or
you
neat,
call Zach.
or you call call Saul. It's better to call Saul, I think, in this example, Greg. And yeah, I mean, we can help you with that. Absolutely.
Gotcha.
Great question, though. Now let's look at the 201 strategy for a CDA. I'm as excited about this as I was about the EBPA 201 strategy. So what I'm hearing all the time, and if you were, if you're at different conferences recently, I'm sure you're running into your peers that are excited about the new foundation that they have or the one that they've been running for years. And man, it's just getting so much traction. Credit unions, literally of all sizes. This isn't just a big billion-dollar group that's doing this. They are as well, but all sizes are starting foundations. And I think it's absolutely awesome. And what you can do if you have a foundation is you control the giving, right? And you have a focus. The credit union has a lot of different focuses. One of them is directly giving back to charities in their community, but they do loans and deposits. You have a lot of jobs. Well, this foundation has one very zoomed in, laser focused purpose, which is giving back to your community. And that is such a great tool to have. And when we look at the regulation, I didn't mention this earlier, but you have a 5-year grace period. If you started a charitable donation account today and you started earning money off of that, you have 5 years before you need to give a penny away to a not-for-profit. And we show 501c3, a typical nonprofit, most people say, that you're used to, and 501c19, which goes to help people that are in the armed forces or veterans, which is new regulation, relatively speaking, which shows that the regulators are wanting to make these programs better and better. So why does this matter? What does this have to do with a foundation? I hear this all the time. We want to start a foundation, but it's going to take some time. And we can help connect you with partners with that, of course. We did a webinar very recently you can find on our YouTube. Dan Holtzman, great guy,
Hmm.
wonderful expert, and he can help you kind of do the legal side of it. We can help with the investing side. But here's the secret is your foundation is a 501c3. So these are now two programs that work hand in glove. You could start a charitable donation account, earn money, get the ball rolling with the foundation. Don't start it for a little while, weeks, months, even years. You will still be able to backdate, look at the income that was generated from that charitable donation account and satisfy the regulation by giving it to your own foundation and controlling where that money ultimately ends up. And now, Craig, anything on that before I jump into this last bullet point?
Um, no, not at this moment. There's a question, but we're going to hold on to it till the end.
Okay, excellent. So now we're kind of cheating. This is a little bit of a 301 here. So every foundation, in our opinion, definitely my personal opinion, every foundation should have an endowment. And what do I mean by that? So oftentimes I hear a credit union gives to the foundation, maybe through the CDA, and then from the foundation, they give it out. No problem with that at all. But what if you split your foundation into two separate pieces? One is what I just described. Money comes in, money goes out. You could think of it as your spending account, your charitable giving account. And the other one is an endowment where it's a pure investment that gets bigger and bigger and bigger and snowballs over time, takes advantage of compound interest, and eventually it'll have a life of its own so that you will be able to give out of the income generated from your endowment. And eventually it could get to the point where the amount of money that's able to spin off of the endowment from an income source could possibly exceed what the credit union has been giving to the foundation all along. And so if you're able to replace that, where it's coming, the life of its own is within that foundation, what is going to happen? You're removing a giving expense from the credit union. Now we're talking win, win, win. I mean, this is just if anybody could fast forward in time and have this in place, I think they would do it. This is really cool.
Yeah. Yeah, I do like that. Well, somebody had asked about why not just move those assets over to the foundation and do one big capital contribution to your foundation that you've created. And I think there's a couple of answers that go along with that because is it a good idea to do? And the answer to that is well, it depends,
Hmm.
right? Because you are actually giving the foundation seed money to create that endowment, which is a good thing, and they can eventually become self-sustaining, as you mentioned. The other thing, though, is maybe not necessarily negative, but something to consider is if you have a CD, you can do that and maybe do a hybrid approach where you retain or invest in a CDA for ongoing support of that foundation, but also control of that money. So at some point in time, let's say you get to a point of you're lent out so much where you need that liquidity back, not necessarily that the CDA is doing a bad thing or the foundation is doing a bad thing, but you just need that money back for either lending or you have a bad year. That CDA is still on your balance sheet in your control, and you can actually end that funding or end that account at any point in time. So you still have that money instead of it being off your balance sheet onto the foundation. So I kind of do like a little bit of the hybrid approach of creating a foundation, maybe a little bit of seed money as they start to ramp up and do events and become self-sustaining over time, and retaining some of that and funding on an ongoing basis through the CDA.
I love that, Craig. Given the option of having more control or less control, take the more control. That's so great because the CDA remains in the name of the credit union. Easy to pull that back if you need it, rather than saying, "Hey,
Yeah,
foundation." I
right.
love it.
Yeah. Guess what?
Guess what? So we gave you a lot of money. Oh God, good stuff. So another thing as a little nuance here, when coming up with a program like this, if you wanted to go into a foundation, having a proper investment strategy on that is crucial. We did a whole webinar on it, as I mentioned, but you want to have a funding schedule and a giving schedule. How much money's coming in? How much money's going out? Are you making enough return to sustain that on a long-term basis? Okay, as we get close to the end of the webinar, we're going to go through some of these screens pretty quickly, intentionally so, because we've already covered them in prior webinars. But when we look at creating a strategy, right? We want to think about the components that go into the portfolio. So there's a fair value aspect that we've covered in prior webinars. I'll touch a little bit on that, but really educating on the different type of investments, asset classes, and having the appropriate policy in place is crucial. Accounting asterisks. We are not accountants. That's my
Yeah,
favorite asterisk.
and there's an asterisk there somewhere. Yes.
It's it's 1.5, but it is there. We do see this as the common practice. There's fair value versus non-fair value. At a high level, it's really this. These programs allow you, if you choose, to have assets without maturity dates. They affect your income statement differently. They run through your income statement. Other asset classes will act just like you're used to, AFS, available for sale. If you're an accounting person, you know exactly what I mean. We go through that in other webinars, and I'd be happy to have a conversation offline about that. Documentation and monitoring. Everyone wants to be having those great conversations with examiners, not oh, I forgot about something. The conversation's not as fun. So we want to have policy creation. We want to have monthly reporting, which we will help you with if we're partnering on this, tracking your income and projecting your income, reporting to the board, documenting it, and of course, tracking credit within the portfolio. Very important.
I know we covered this, Zach, in 101,
Mm.
but just to really do a high level and with these bullet points, there is some regulatory component here on notification on this. Is that correct?
It is our recommendation that you notify your regulator. That is something that you should definitely do. Absolutely. And do it at the very beginning stage, right? Just say, hey, I'm having conversations with my executive team, with my board. We're looking at doing this. And just so you know, we're thinking about we're putting everything in place that we need to, like policy. And they're going to say, great job. And they're going to ask you about risk assessment as well, other things that we can definitely help you with.
Yeah, good. Thank you, sir.
Yeah, you bet. Okay, we're close to landing the plane here. So I think a good way to think about, I want to do this, but I can't. Okay, let's talk about some of these things. What if you don't have liquidity or your liquidity is not as hot as you want it to be? Well, you could run a swap analysis looking at trading out of investments that are yielding lower into this. Great idea. That works sometimes. Sometimes it's more beneficial depending on the shape of the yield curve. Won't get into it, but we want to look at that for sure. Also, just start small. You do not need to fully fund, as you mentioned, Craig. It's way easier to add than it is to just get the thing going. So get it going and then add as you have the liquidity coming in. Lacking understanding, right? If you got this far in the webinar, it's probably you say, hey, I understand more than I did before. Maybe there's still some things I don't understand, or maybe I get it, but I have other things to do and I don't want to, I can't, educate my board like I would like to with the timing that I have. So we can help with that. We can educate your team. We can educate your board. It's incredibly important to have that understanding. Time and effort. I would love to do it. Don't have the time. Don't want to put in the effort. It's probably more of a time issue. Um, we can do the heavy lifting for you, such as policy creation, account opening, and of course the investing itself. We'd love to help you with that. Take that off your plate. My favorite objection, because it is procrastination, Craig. I'll do it next year. And it's not always procrastination. I'm kind of joking, but you may say, "Hey, I don't want to get this going until next year." Two trains of thought on this. Number one, we still have a full quarter of earnings left in the year. Let's finish strong before interest rates go down further. It's one train of thought. But if you're thinking, no, I get it, but this is on our agenda, we will look at this January 1st, 2025, that's what we've decided. I'm not going to argue with you on that. I totally get it. So what you can do is you can open the accounts ahead of time, get the policy in place, do all the things we talked about before with notifying regulators and getting education. And then on Jan 1, you can fund that thing and you'll have a full year of earnings rather than, hey, we'll start to get it going in January 1. You can really put those pieces together today.
Gotcha. So the credit unions, have a lot going on, and it's not like it ebbs and flows. It's constantly going on, whether it's the working on the deposits, the lending portfolio, the strategy for growth. It's just constant, call reports and stuff. So I do like the fact that you're talking about it's not a hard process. It just takes a little bit of time to go through it. And it's good to start putting some things on agendas for meetings to discuss. This is kind of the thought process. Talk to the board. Hey, this is something we're considering doing, and see if they have some good questions and see what they can ask with respect to identifying hurdles or opportunities in support of it as well. Oh, it does take some time, and I like that idea because just those conversations, as we know, take time to get on agendas. 'Cause sometimes they get really full.
Absolutely. I hear about it all the time. We'll put it on this month's agenda, and maybe that's 2 months out. It takes a little bit of time. But really,
Mhm.
once the process gets going, it's actually pretty quick.
Yeah.
Yep. All right. So let's look at everybody wants to know, what do I do next, right? If this is something I'm interested in. So we want to have those discussions, educate the board and the executive team. We've already mentioned notifying regulators, and then let's define our goals. So we'd be happy to help you with that side of it too, right? I want to give more. Okay, how much more? I want to give to my executives. How much? When? Right? We'll help you define those goals. And then, of course, a risk assessment to determine the type of portfolio that makes sense for you and get that a policy approved. Definitely can help you there. Nobody wants to think about, I got to create a policy. Don't worry about it. It will be customized for you, but we can definitely help. And then opening the account and actually getting to invest. That's really the next steps, Craig. Very simple, straightforward.
Okay. There's another question that came through, and Zach, I'll phrase the question. It's the words are a little clunky there, so I'm going to smooth it out and have you answer it here. You mentioned a lot about alternative investments that would otherwise be impermissible in a standard portfolio. And the question is those seem complicated,
Hmm.
is the first part of the question. And then the second part of the question is do we need to open like a different type of account than our normal custody that we would have with our normal custody agent for our standard portfolio?
Great. I'll handle them in reverse because that second question's super easy, right?
Okay.
So great question, by the way. Um, The accounts we work with, a custodian, right? Charles Schwab is who we were working with right now. They're a great custodian. And so you would have a separate account number, a login to see your account. It's actually, the owner of that is the credit union, but we keep this completely separate. And that's really important because you want to have good monthly reporting. How are you going to do that? You've got a list of all your normal assets mixed in with your EBPA and CDA. That's a big mess. We got to pull it apart for reporting. You want to pull it apart for accounting and tracking what the income is. Just for all of those reasons, we want to keep it separate. So, great question on that.
But still stays in the ownership of the credit union.
That
That
is absolutely right.
Perfect. Okay, so
Yep.
number two is what happens if one's not necessarily really familiar with the complexity of some of these investments?
Yeah, I think there's a couple ways to think about this. Number one, just being educated, right? But really, I always think in analogies. Ask anybody I work with, and there's like 10 analogies a day. It's just how my brain works, right? So if you think about your own retirement, right? Different people are going to have different types of 401ks or IRAs, but the first step is they want to understand it, right? You're going to have somebody who is maybe closer to retirement that is in all bonds, maybe somebody that's a little bit younger that's in equities. And they need to understand what those things are. But really, and I'll pull this apart just even more. Some of these asset classes are what you're already familiar with. For example, you may be familiar with a corporate bond, or maybe you're a federal credit union and you have bank notes. Well, now we can go into corporate bonds that might be a little bit longer in duration or a little bit lower with credit and higher yield within reason, of course, just like your loan portfolio within reason. But that is a type of comparison that you can think about. It's not much different than what you're already used to.
Right, makes sense. So the education and support would be there for identifying, going through risk tolerances of educating on something that might be new and determining whether it is appropriate or not for or prudent for the risk tolerance of the institution. Yeah, so that's
Absolutely.
all there. Okay.
Absolutely.
All right. Well, let's turn to page one more. I want to make sure we end on a note to share with everybody our next webinar, which is going to be for the industry update for planning and budgeting. It is budgeting season, as Zach, you mentioned. It's
Good
a great
segue.
time to be thinking about it. EBPA, CDA for 2025. That's on October 22 from 2 to 3 o'clock. Again, this webinar will be on our website later on today. And if you need a copy of it, please go to there. You can download or ask your rep to send it to you. Zach Whaley, thank you for all of your knowledge and sharing all of it with us today. I really appreciate that. Very informative. And all of the clients out there, thank you for taking the time. Prospective clients, for taking the time today to learn a little bit more about a fascinating and very valuable subject.
Yes, thank you, Craig, for your time, and thank you, everyone